We're going to welcome JB today with 20 years of investment experience. She's a portfolio manager with Tribeca Investment Partners, an Asia-based investment and advisory firm that's been partnering with sophisticated clients across asset management, private wealth, and corporate advisory for more than 2 decades. JB has doubled AUM to over $1 billion, making it one of the largest long-short equity funds in the Australian market. She's the PM of Tribeca's Alpha Plus Fund and has built a successful 18-year career at Tribeca. That's a pretty long run. I know that most marriages are only 9 years, so you've doubled that. JB is a volunteer for the Raise Foundation Board and continues to look for opportunities so she can share her experience and network to benefit others. She's been appointed as a core fund manager for Hearts and Minds Investments, which provides a concentrated portfolio of the highest conviction ideas from leading fund managers while providing vital support for Australian medical research institutes. She completed a commerce degree at the University of NSW, followed by a number of additional finance credentials, including GAICD and CFA. JB is a prolific contributor to Australia's financial services sector, writing a regular column for the AFR and making frequent appearances for key media outlets, and is a speaker at industry events. She serves on the advisory committee for Australian Student Asset Management and is a TEDx speaker, and we'll find out today if she sleeps. Welcome, JB.
Thank you so much for having me. And you know what? You're right. It felt like a marriage with my my current job. It's been a long time.
Well, welcome. I know it is the start of your day, and it's pretty crazy here in the market, so we'll get to it. You know, I would love for everyone to hear a little bit more about your investment philosophy. Maybe talk a bit about what you look for in a long position and how does that differ from a short position?
Of course, look at my investment philosophy. Actually, it's very similar between long and the short positions. What it is that, we do our investment research from bottom up. We find the companies we love. We sometimes in that journey to find the company we love, we come across the companies we don't love. And, and then you do your investment research and you meet with the management, and then you understand where the intrinsic value of the company is, i.e. what would you pay for that company? Now, what we have found, especially over the last 20 years, I have realized that the market is actually very interesting. That's why you want to be part of the equity market, is that the company's intrinsic value often is not reflected in the share price. And what investors willing to pay for a company, it changes from time to time, depends on how they're feeling, whether they, feeling bullish or feeling scared or feeling greedy. So that value actually changes over time. And what we do as a professional investor is take advantage of that changes in what investors willing to pay at that point in time. I must say my investment philosophy is somewhat contrarian at times. We seek out very deep value propositions. Now when we talk about deep value, it's not just cheap stock. So when I talk about deep value, it's much broader application or definition. It's essentially company we see has incredible amount of quality, growth, and value that is not recognized by the market. It may be a growth stock, maybe a tech company, or it may be a very cheap, deep asset play. So so our value is essentially anything that give me potential a lot of upside. And then when we find those, we take position in them, and timing sometimes is everything. So we will build our position over time, and when we see the catalysts come through, and we often are the first one to really be positioned in those companies. And when we talk about the short position on the other side, it's actually not very different. It's when you go on that journey, you find a company that market is perhaps paying too much for it at that point in time. So what we do is that we gradually build a short position in the expectations, and the share price will fall. Sometimes we can do both at the same time in the same sector, and which is even better. We long one company in that sector and short another one. Net, we actually make money on both sides.
And JB, sometimes it's kind of like people. Nice people hang out together and quality businesses hang out together, right? So if you're thinking about, doing due diligence on the long side, maybe there's a really great management team and a good business model. Oftentimes, even if it's not as great of a management team, they still have a good business model. So will you short, call it a quality business if the valuation's too high? Or how do you deal with those more fundamental factors versus the valuation on the short side?
Yeah, that's a really, really good question. That's actually is what often caught out the long short managers, because if you don't get the short right, you can lose a lot of money. Now, what we have found is that shorting something just simply based on valuation is not good enough, because that might take a very long time to play out. In many cases, for the last decade, when we had the cheap money, when interest rate remained low, many of those companies went on a crazy rise in terms of share price before they eventually collapse. And quite frankly, most of the long short managers' pockets aren't that deep. So what we do is that we often first you identify the more expensive companies, then you identify in that basket which one or which company will have earnings disappointment. To me, and most of what we found based on our decades of experience, is that when companies' earnings started getting downgraded, that's when you started having problems. If a company, especially if a company trading on very, very big multiple, a big valuation, and if they're going to disappoint the market, clearly that is not going to be taken well. So if we can find those ones, and often we do find them, is that not only will have the fall in the earnings downgrade, say 10%, it will fall 10%, and then you have the fall in valuation, it could be another 30. So net, you actually generate so much return just by identifying some of those discrepancies in the marketplace. We can name many examples in our portfolio. We have had those shorts that just generate so much return. So ultimately, it comes down to the turning point in the earnings versus the analyst expectations out there.
That's helpful. I think it's good that's why I wanted to kind of get into that a little bit, because valuation is rarely a catalyst, but it could be versus expectations, an upcoming event, something that's going to disappoint people. It could be user growth. It could be, something else that's going on with the product launch. So it's helpful to go through that. And the other kind of big picture question here for you is for the alpha portfolio, what does it look like in terms of the number of positions? Are they all Australian names, or, where are you investing in the world? What's your typical hold length, or what other factors are important to you when constructing a portfolio?
Absolutely. So my portfolio is not a concentrated fund. It's a diversified fund. At any point in time, I hold between 90 to 100 positions. So around 70 long and 30 short. My portfolio is benchmark aware. So that's ASX 200. And most of my positions, probably 90% of my position is the ASX 200. And then the rest can be into other positions where there's newer coming outside index and potentially further down the track into other index. So so the portfolio itself diversified. I have found when I construct the portfolio, I tend to keep most of the macro sectors, sort of macro exposures neutral. Now, how do I do that, and what do I mean by that? I have found based on many decades of experience, when a portfolio started pricing in, putting a lot of macro thematic into the portfolio, unless you have very strong expertise, and many in the world perhaps have that expertise, but not many have done so consistently. And given we're stock pickers, I'm a stock picker. I know the companies very well. I know most of I probably met most of the companies, in the Australian market over the last 2 decades, and not only their management, their board members, and everyone. So so I know those businesses very well. So stock picking is very important. So I take out the macro thematic. I keep my exposure to things like growth, value. A lot of those factor exposure are reasonably neutral, because I find when I keep them neutral, I can actually take advantage of whichever is fallen out of favor. That's how I stay ahead of everyone else. Be a little bit more contrarian, and then I can generate return once the market then want to come back to it. So and then the long short exposure really helped me to take out the risks as well. So we for example last 2 years, over the last couple of years, really, we had that huge rotation out of growth stock into value stock when we had interest rate going much higher than expected, as well as inflation. And how do we manage in that environment is to keep things reasonably neutral. And then when the opportunity presents, it might be out of favor, we can jump in and buy them. With the ability to short, we can short something else in that sort of similar flavored basket. So net, we have found it really allows us to be able to deliver return consistently throughout the market cycle, and then be very, very nimble when the opportunity presents.
And, one of the interesting things, we invest globally, so I happen to know a little bit about the Australian market, is that you have some big sectors there, financials, materials, right? You kind of start to go through it, some very large consumer businesses. How do you get around the fact that the benchmark, so something you're playing against, has some big positions, in terms of not just the companies themselves, but the sectors themselves are quite large. Are you just neutralizing that? But then if you're neutralizing it, the benchmark's not neutralizing it. So how do you think about playing against the benchmark when you're trying to, you kind of have to take a position because you're playing against, call it a soccer team that doesn't move that much.
I tell you what, Australian market, Australian ASX 200 actually has been a tough benchmark for many managers to really beat, particularly long only managers. I tell you why, because the particular things you highlighted, these big companies, big sectors, and then a lot of them are highly dividend generative,
Yes.
and they're high quality businesses. So so for many, particularly long only managers, they really struggle to beat that index, because the only time you want to buy anything else to generate extra return that's better than the index, you have to sell, not holding
Right.
these.
Not hold that, yeah.
That's right. And then buy something else that's small. And then during times of volatility, well, and a lot of times, they actually get wiped out because you don't have any other choice of funding your additional investments except using the larger quality companies. Now, as a long-short manager, I can do so much more. I can short very small companies, or low-quality companies that's not sitting in that top 50 position. I can sort of, using those to fund whatever I think investment return will be, and I can match their volatility. I may well hold one of the bank, or one of the resource, and
Sure.
but then I can short some other resource within the same space, keep them reasonably neutral, and I can pay the size differential. During times of risk on, I may want to hold a smaller, high quality, high growth companies, and then underweight some of those larger ones, and then just to get my differential in terms of mismatch. So there's just so much way of making money when you get long short compared to long only. That's why Australian sort of ASX 200 has been one of the hardest index to beat, but we have consistently to be able to do that.
And so, it's been a pretty exciting start to the year, including a start to the week after, last year being a pretty exciting year. Looking ahead, are there specific themes or names that you could discuss that you find interesting, either you're working on, investing in, and maybe why they're prioritized for you?
Look, I think the theme for 2023 is going to be the China reopening. That is going to be the key theme, and it is going to drive a lot of return. Now, so because 2021 is going to be a year where China is going to grow about 5%, and then the rest of the world will slow down, and if not heading into negative territory for many of them. And 2024 perhaps is somewhat similar. So you really want to gain exposure to that sort of where the growth is, and plus the pent-up demand that is coming through the China reopening. In Australia, it's actually a great market to be able to gain that exposure. Now, what areas are we looking for? Things like to do with consumer services, travel. Chinese traveler is coming, and right now their domestic travel, just given within a few months of reopening, their domestic travel is through the roof. It's way above the pre-COVID level, but their outbound travel out of China has been only 10% of the pre-COVID level. Why is that? Because of the massive backlog in visa, and it's not the demand, it's just the visa backlog, and they couldn't get through at this point. So the pent-up demand is enormous, and they're coming with a lot of cash. I think something like $1 trillion was close to $1 trillion was saved. There's a lot of saving, especially for the upper middle class. So when they're ready to travel, they will spend. So you want to gain exposure to that tourism side of things, to really be part of it. Students is another area where we think they are coming as well. With the reopening, and then with encourage from the government, they will travel again. That might take a little bit longer, just simply because the school terms need to be planned a little bit ahead. Aside from that, I must say our commodity companies look pretty good, and I hate to go to the old industry, but it is the industry going to benefit.
Well, you're either in Rio or you're not in Rio. I mean, you got to decide what you're going to do. These are important.
Especially with with the current sell-off in the resources space, you want to take advantage of that. You want to be part of it. Every indicator in China is looking very strong. Even the housing is stabilizing, corporate spending, consumer spending. So things looking very strong. Next 6 months is looking incredibly strong for the demand for the hard commodities. So we do think they will ride pretty well given the current sell-off as well. So there's a lot of area that's coming through. And of course, if you have any business that's directly exposed to the China market and Chinese market, whether you're treasury wine or whether infant formula, I just think that you want to be part of it and take advantage of current market risk off and the like, and the return will come through quite quickly.
I don't know your portfolio, but I can guess some of the names. We play in the same thing. Is that the China reopening is different from before, right? It's not infrastructure led; it's more pandemic led. So you're talking about travel, you're talking about education, you're talking about luxury spend, or spend from savings at various levels. So that's a helpful connection to make for people, which could apply to Japan or other places as well as they're thinking around the world. So I think that's something to note. Maybe talk a little bit about how you define risk. Obviously, you mentioned that you have a short book and you can get rid of some exposures or some parts of the benchmark where you might be less comfortable taking a position. If you could, define risk for you in terms of your portfolio, and then how do you deal with risk management at the portfolio level and then the individual security level?
Of course, that's a really good question. Ultimately, investing in the market is about taking risk, but you want to take the risk that you want to take, and you want to take the risk that you get rewarded for. Don't want to put your money up for nothing. So what's really important is a portfolio level. We run our risk model every single day. So we built this in-house built risk model, and we run it every single day. We see our risk exposure, where the risk is coming from, whether it's at the factor level, whether it's growth value, whether it's momentum, whether it's sensitivity to different markets, sensitivity to different commodities, sensitivity to gold, oil, interest rates. So we look at every layer and every perspective, so we know what risk we're taking on. If one of them going a little bit out of whack, we will need to think about, is that the risk we want to take on? And is that the right way that we want to think about our portfolio? So we keep those risk estimate reasonably tight. During times of, say market transition and the like, I used example previously, like value to growth and everything. During those transition times, we do keep them reasonably neutral, some of those factors, because we want the stock pick to come through, picking the right company come through, rather than we factor every now and then that wipe your return. My view is that whether you're quant, whether you're fundamental, you just need to be aware of what's happening in the world, and then take advantage of them, rather be behind, a little bit slow to some of those changes.
And when you think about interest rates, obviously that was a huge story for 2022, and as you mentioned, having value outperform growth, long duration getting hit. When you look at 2023, in particular for the Australian market, you and I before the interview were talking a little bit about the housing market, but maybe you can give your view, and maybe you guys aren't playing rates, but do rates matter for you this year? And if so, how would you advise people to be positioned in the Australian market?
Sure. Look, rates still matter, even though despite the current volatility created by banking crisis in some areas, that we still think at this point that some of those crises seems to be well contained, and there's still, it is the inflation, expectation of inflation, and then where the interest rate is going to dictate the market return at this point. Now we think the rates will continue to go higher, probably just a few more. In Australia, the central banks are very pragmatic. They took it very slow. They were a little bit behind everyone else, but they took it slow. They wanted to see how economy is behaving. The good news is we started to see inflation somewhat coming off, but just not yet fast enough. So I think there's probably another 2 to 3 rates ahead of us to go higher before they will pause to see how we go from here on. Our housing market's fallen more than 10%, so something like 11, 12% in the last 12 a 12 to 18 month. Potentially there's a little bit more weaknesses given the lead indicator still demonstrating sort of weak sort of housing listing as well as the put through. But our view is that this number is probably going to trough in the next 3 months before we started seeing more healthy demand coming back. We are hearing there's a little bit more interest at the investor level into the housing market that has the pockets of areas that's fallen more than 20%. And if the immigration does come back, quite frankly, in a few years we'll have underbuilt again in the housing market. So I think the fundamental for housing is reasonably strong. Consumer is still doing pretty well, but they will slow down. But my view is that we're not talking about a recession. We're not talking about a cliff, a cratering in activity, if you like. Particularly given resources is doing quite well. It's bringing a lot of cash back into the economy, and then we'll be benefiting from the students, from the travel. So our economy is looking reasonably healthy for the next 12 months.
You're trying to make us jealous. No, I'm kidding.
The weather's going to
I sit in Silicon Valley, so that's a different feeling around here right now.
I know you're right in the middle of it.
maybe we need to get out to Australia. Looking back over your career, you've been doing this for a long time. So, what's one of the greatest lessons learned in your career that you could share with people today?
Look, the lesson learned is that every day actually gets reminded of this, is that don't follow. You need to get rid of the herd mentality, especially during times of volatility. We can see it in today's world, the investor gets impatient, and when the share price is not working, they kind of sell it. They follow what everyone else is buying, and given the volatility in today's world, that is incredibly bad strategy to follow. You need to stick to what just work out what your strength is. The strength is knowing the stock well. Find a company you want to buy. Wait for the share price to come back to you. Don't be scared when it does come to you, that share price, and buy them. Just think it's like a cloth or jacket. It's on sale. Buy them, and then really have the conviction in what you buy, and then just let it does its thing, and eventually share price will go up when money goes higher.
JB, I think a lot of people are going to want to talk to you about the Australian market. So how can they find you, whether keeping up to speed on what you're doing professionally or reach out to you personally?
Yeah, absolutely. So my company name is Tribeca Investment Partners. So the website is tribecaip.com. And also I'm on LinkedIn, Jun Bei Liu. And you can follow me on there. And I'm quite vocal about what I believe, what I see in the market. Look forward to hearing from people like mine who want to talk about the markets.
Well, fantastic. Thank you so much for sharing your experience and insights with us today, JB. We'll let you get back to the market. I know it's the beginning of your day. Have a wonderful day, and thank you again so much.
Thank you so much. Thank you for having me.